My guest today is Alma Angotti, partner and co-leader of the Global Investigations and Compliance Practice at Guidehouse. Alma is a globally recognized expert in AML, CFT, and sanctions compliance, who has spent the last 25 plus years in regulation and enforcement, having held senior positions at the US SEC, the Financial Crimes Enforcement Network, that's FINCEN, and the Financial Industry Regulatory Authority. Alma, thank you so much for joining me today.
Thank you so much for asking me. I'm pleased to be here.
So Alma, at the outset, can you speak briefly about your current role at Guidehouse and the learnings that you bring with you to this role from your long career spanning regulation, advisory, and law enforcement?
Sure, I'd be delighted. So I have a really incredible team that I co-lead with Salvatore La Scala of about 550 true financial crime experts, a great compliance technology practice, investigators, people who have worked in law enforcement and banks and other kinds of financial institutions. And what we do is we help the financial institutions navigate how to identify and mitigate their financial crime and sanctions risk. Some of them are proactively embarked on that journey. Some of them are getting encouragement from regulators to embark on that journey. And recently we have been, more and more of our clients are financial technology firms, payments, cryptocurrency exchanges, and other kind of crypto and blockchain digital assets businesses. So it's an exciting time to be in this area.
Excellent, excellent, Alma. So Alma, over the years, whenever there is talk about AML CFT frameworks, a lot is spoken about, the tone from the top and building a culture of compliance. Now, while each bank may determine its internal tone of compliance based on its risk appetite, how do you think boards and senior management can actually influence this positively across levels within the organization and also make a sustainable change to ensure that the bank is operating at the level of compliance that is expected? And even if the board is setting the right direction, using all the right tools, in your experience, where does the breakdown in compliance usually happen and why?
I am so glad you asked me that, because this is something I've been talking a lot lately to a lot of our clients' boards when I'm doing training for them. And I think if you had to sum it up in one word, it would be accountability. And what I tell the boards is everyone's policies, every company's policy says we're going to obey the law, right? No board of directors is going to say we might if we feel like it. The issue is, do the people who work for you believe that you mean it? And there are three kinds of people in any organization. They're the ones who will never, ever break a rule, ever. These are the people who don't get parking tickets, right? Then and we don't need controls for them because they will always do the right thing. Then we have the people who will always cut corners if they have the opportunity and think they won't get caught. Those are the people we need controls for. Then there's this big group in the middle, and they want to do the right thing, but they start to feel like idiots if they see people breaking the rules and getting away with it. So the board has to make very clear expectations of their ethical obligations of their teams, and they have to make sure there's accountability for failures. And even more important, positive reinforcement for people who do the right thing, right? People who identify risks, who raise their hand, who take their training on time, who raise issues. They need to make sure that the rest of the organization feels that those things are valuable.
Right.
It's not
right.
easy, but it can be done.
Great. So, Alma, regulatory expectations are ever increasing. I think we all know that. And banks and FIs are under increasing pressure to demonstrate effectiveness, right? Effectiveness is, I think, the key word these days. But incidents such as the recent FinCEN leaks suggest that even regulators arguably have yet to go a long way, to keep up with the private sector in terms of the ability to process the information that is supplied to them. So what do you think are the challenges that regulators are facing, and what might be required to create a more effective system?
So the regulators have a lot of the same challenges that the banks do, right? And the one thing about the FinCEN leaks is those are really success stories, because those show instances where the financial institutions have identified suspicious activity. Now, they are not proving criminal activity. They are just raising their hand to law enforcement saying, you might want to look at this. Like government agencies all over the world, law enforcement has limited resources. They get limited resources for technology. And so it could be that. It's also could be that we don't know how many of those activities leaked in the ICIJ leak are being actively worked by law enforcement. There may be investigations going on. They take a long time. Law enforcement has to prove it. Banks don't have to prove it. They just have to see it. And so there can be quite a lag between what's identified in a suspicious activity report or suspicious transaction report and when law enforcement can take action. But I do think it's probably just you only have so many law enforcement people, and so they have to prioritize too.
Right. So, Alma, it has been observed in various jurisdictions that FIUs, sometimes have a phased approach in ensuring that all sectors of reporting entities, whether they're banks, brokers, mutual funds, insurers, etc., start complying with reporting guidelines. Now, this could be due to a risk-based approach by the FIU itself, or constraints of technology or staffing. You also just mentioned that they could have some resource constraints, right? But it appears that over the years, placement of illicit proceeds just shifts from the well-regulated institutions to the poorly regulated ones. So do you see this as a systemic deficiency? If so, is there a possible solution?
So here's the thing, right? There is a certain amount of criminal proceeds in the world, and it's like a balloon. If you squeeze one end, it comes out the other end. So one of the goals of what law enforcement is often doing is to disrupt those methods and institutions that the criminals and terrorists are using, because there is some cost to them in that disruption. They have to think of new ways. They have to identify new methodologies and typologies that can make it more expensive for them, that can make it easier for law enforcement to find. So I think inevitably you will see criminal proceeds shifting around. For example, there are lots of studies that there's more money laundering now through trade finance and trade-based money laundering, right? Because the regulators have been very tough on the banks. A lot of them have improved their programs recently. So yes, the bad money is going to move around. The best thing that law enforcement can do, again, is more technology to identify where it goes. You see them expanding the coverage of the various anti-money laundering regulations in different jurisdictions to try to account for that. So it's not easy, and it's not going to go away. And I think everybody's just doing the best they can.
Right. And I think maybe we need to figure out how to burst that balloon rather than, shift
exactly
from one side
yes.
to the other.
But as long as people can make money from doing bad things, people will try to make money
Yes.
from bad things. I mean, that's just the human condition, right?
Absolutely. Yep. So, Alma, you've been a regulator, I think, for most of your life. So, either during the normal course of reporting or when some regulatory or reporting lapse takes place, what would you say are some of the best practices that banks or any other reporting entity should follow when dealing with regulators and law enforcement agencies? Do you have any sort of tips for them?
I do, actually. So the first thing that I think institutions should do is be more proactive than they often are, right? if you are in an enforcement setting, you lose control of your program. You have the regulators telling you, you will do the following 10 things in the following timelines, and that can make it extremely inefficient, and you lose control of your own risk appetite. So the first rule would be not to get into that situation in the first place. Try to be more proactive. Invest in technology, invest in human resources, invest in making things more effective as well as more efficient. So that's the first thing. The second thing is, if you find yourself in that problem, you need to talk to the regulator, tell them right away. Tell them, we found a problem. You need to tell them that with an action plan that you are going to follow to fix it. You're going to say, we have found X problem. Here are the 5 steps we're going to take. Here's the timeline. Here's who in our organization is responsible. And here's what we've told the board and senior management, right? So you want to, again, take control of your own story with the regulators, because frankly, the hallmark of a good compliance program is finding your own problems. So it's way better if you identify it, you tell them, they will typically give you some free rein to fix it in a way that makes sense for you, than if you ignore signs that you have a compliance breakdown or a risk misidentification or a big technology problem, or what we see a lot these days is, because of all the consolidation in financial services industries, the systems don't talk to each other, they break down, there are data quality and data integrity problems. Also, as compliance gets more technology focused, it can be hard to get the resources, the data analysts, the technology people to really tune and test your systems properly. So again, you want to take control before you have a problem. But if you have a problem, you need to take control at that point. You need to own your story. You have to give, in my experience, regulators have a lot of confidence in you if you do that. And if you look at the most recent Department of Justice guidelines on compliance program assessment for deciding on a criminal action, one of the things they specifically said now is, we're going to look at your compliance program when you had the breakdown and your compliance program when you told us, right? Because sometimes we get into a lot of discussions with clients, well, if we fix it, it's going to look like it wasn't good, and we're admitting that, and maybe that is true, but they want to see that you've said, oh my gosh, here's what happened, here's how we're fixing it. And it's just critical, or otherwise you're going to be doing what somebody else tells you to do instead of what's best for your organization.
Right. I think, what you said makes a lot of sense. No, I think it makes a lot of sense, especially the own your story bit. And I think, I would add to that saying that, make sure there's only one story.
Yes. Oh, absolutely.
Right. So, Alma, the Fintelekt community consists mainly of compliance folks. So, in these uncertain times, especially when there are new crimes and typologies emerging, there are pressures due to staff working from home. New regulations are coming up all the time, and there are rapid changes in the sanctions environment. So what is your advice to the compliance community? What should they do to ensure that they can still be effective, efficient at their jobs, and more and more relevant?
So as I often do, I'm going to start this answer with the story. So I was at a conference in Berlin last summer, and you know how they have those polling questions before conferences. So the question I asked 200 very senior compliance people was, what is your biggest challenge today? And the selections were changing regulatory expectations, the cost of technology, or the business doesn't understand the risk. 70% of the compliance officers said the business doesn't understand the risk. So I said, that is literally your job. That is your fault if the business doesn't understand the risk. So I think that is the main thing compliance officers have to do, is very carefully cogently and in a data-driven way inform their senior management and their board of the risks of their institution. That's what they want to know. And that is actually their job, is to manage that risk. Your job is to advise them, but they can't do it if you don't tell them. And I got to tell you, we see it over and over again. Then if there's a big failure, they're going to blame you if you didn't tell them. You're not helping anyone. And look, business people, nobody wants to launder money for bad guys and terrorists, right? They just have to know. Now, it's not an easy job, because you are essentially proving a negative by telling them all of this money we've spent on these controls, we haven't had an incident. But I had one compliance officer when I was a regulator who, every time, it was a clearing broker dealer, and she would often recommend the business get rid of some of the introducing brokers who were very high risk. Every time those introducing brokers ended up the subject of a FINRA or an SEC action, she'd bring it to the CEO and say, here's what I saved you from, right? So it can be hard. I'm not saying it's not hard, but you have to be able to do that. That is probably your most important job.
All right, excellent. So Alma, with that, thank you so much for joining us today. I'm sure this is going to be very, very useful to our community. And thank you for sharing the time and the effort to prepare for this session and for sharing.
Well, I enjoyed it very much. Thank you for having me.